Hi, good morning. Uh, Welcome to this Zoom call Wednesday, and just gonna make everything live online. Welcomes to this Wednesday, and I haven't been doing this Wednesday Zoom call. At least I'm hosting it and doing it. The presentation myself has been so all of you guys who are joining us on Facebook, um, on YouTube, love to encourage you guys to join me and to on the Zoom call. Um, this is this is a this is honestly this is pretty it's something that's very good happening for what we're doing here is we're doing this on every week, something that I'm really proud of. Um, Week in and week out, and we've been doing this share. We have been sharings on basically what I'm truly believing in, investing in the U.S. market, and I see some people returning. Good morning. Returning to the meetings, week ins and weeks out, and I think that's going to be I think this is going to help what you guys doing in terms of investing in the U.S. or learning how to do in commercial real estate. The truth is, this is I showed down. This is a Zoom call number 18, and I've been sharing on different topics since the beginning of March, and that's what the time that I started on doing this Zoom call. I decided to have every week we're gonna have a meeting. Every week we're gonna have a meeting, and I'm really glad that these people keep returning because I see the market, it's slowly stabilizing, and some of you guys has been keep returning, and of course the reason is um, um, you're really serious. That's just no other way to put it. If you are really serious about what you're doing and that you keep returning, I would like to thanks for you guys doing it. But um, just like any other call, like last couple of weeks I have meetings, I have interviews with investors. The previous ones is someone from Toronto who is investing in real estate, doing really well. And the previous one I've introduced and invite our Nami, who is a mortgage professional in Canada, and sharing with us how we get loan and giving us some of the nuggets, some of the insight, how you can get loans from commercial real estate. So, but today it's gonna be one thing that I really find out that the small shorter meetings really work well because it's during the day. Today is one of those, but I want to touch on what is the best market I see, what's the worst market I see, and really what now? Really what now? It's with a lot of noise. I say noise going out there. Saying someone say that the real estate will go down, real estate will not go down. Really, what can you do, right? What can you do to take charge of your investings? Whether you're passive investors, like many of my investors, or you are active investors like me or some other guys who have been doing this. So I would say you have to pay attention to that. But really comes down to knowing the best market, knowing the worst market you can avoid, and I listened to a call yesterday, and is a fund that have almost close to 2 billion AUM, asset under management, um, and they have the similar, uh, very similar strategies, and that is to buy apartments, low garden, 3 to 5 stories, and B and C class in secondary market. Hitting all the you can say that hitting all the right, same I would say um, same criteria that hate to break. What we are truly believing in, finding a right market, finding a right deal, and can you hear better now for you? Sorry about that. Sorry about that. Let me know if you cannot hear good, because you can join us also on the link that I provided. Go to the Zoom meeting. Go to Zoom meeting, and I will admit that on under that, because you actually see the slides as well there. But I apologize. Yeah, it maybe try to do it on the let's see, try to do it. I can hear. Okay, thanks, Will. Thanks for the feedback, Will. Yeah, so someone's in the Zoom meeting. Let me know that it's better on the Zoom meeting. Would you please add if you can add yourself to the Zoom meeting? I have shared the links on the YouTube share as well. Thank you. Yeah. So I was listening to a call that is from a CFO, and yeah, they have a lot of asset. They have mostly in Canadian soil, but it's a similar strategies to buy and to really improve the properties, and give the return to the investors. So that has been working for big company like that, or mediums company like us, and that works. But today I want to share on um, on some of the good market and the best market, but really connected with, I haven't really chat with some of you guys for the last few weeks. I've been doing more marketing um, with other people, but really it doesn't change, like the big you can say the big underlying strategy is really not change, and it will not change. I will argue it will not change, because you still have to find the right market, and you still have to do the market, raise a capital, and you have to build credibility and create a team, finding the deals, um, create a team, fund a loan, find the investors, and help them. Really help them. So all those things does not change. Um, and what may be changing a little bit for what we're experiencing right now, maybe underwriting strategies, you have to be more um, uh, conservative. Which we have adopted for the last um, a few months. We're much more conservative in terms of underwriting, and the good news is, what we are seeing the market do is we actually see more lucrative deals, like more deals. And we know from experience, we went through this once in 2008. So this is not new to us. This is going to be creating, this is where the time that we grow. It happens to us in 2008 and after that. And this, we know that is the growing stage. And that's why we're doing all these Zoom calls, all this meetups, because we know that we have to really build our team. And really we have to really build a relationship with investors. And because this is a time that within the next 6 to 12 months, this is a time that's really crucial, and the market will slowly stabilize, and a lot of deals will be surfaced. And as the deal flow where we are creating with our teams on Ohio, on US, coming in with more deals, and coming with more lucrative deals. And last week alone, I look at 10 deals that is ranging from 50 units all the way to 250 units. And the deal flow have increased. And the underwriting strategy is, as we touched on a little bit earlier, is you have to be really careful. But it doesn't deviate. Whether you have a good market or bad market, you still have to do your market research, raise your capital, and build your credibility. And talk about raise capital, and we are very fortunate that we are at the end of finishing of refinances. We bought in our first with 2 years ago. We bought in a multifamily property, and we are increasing the equity of over 800,000 and just in the 2 years time span. With that, what we are able to do is we increase the property values of 56% in the 18 months or so when we're doing what we say the lipsticks, but what we really is doing going inside the unit and doing changing what is necessary to bring up the rent. And that would be partially new bathroom, partially new kitchen, basically bring up to the standard that tenants will be able to absorb and increase the rent of, in our case, $175 um, over 50% of rent increase. So that has been done really well. And now with that success, and what we do is we know that that is repeatable strategies. And honestly, whether that is a good market is actually tough to do that. In what we're going to see in is going to be adjusting market, it's going to be so much inventory that we can find and we can actually unleash those opportunities because we are able to get in some of the units. We're going to be able to find unit under 30, under 25,000 per dollars. So we talk about huge value propositions here to be able to enter it correctly. So but it doesn't deviate. Um, a little bit of our story is we first investing in Canada 2006, and we entered the single family residential market and we expanded beyond our home in Calgary and eventually into China and Hong Kong, which is where I'm from, and also investing in China as well, which is I'm not from China um, originally. I mean, I'm from Hong Kong, China, but I'm from the south part of the China. But we also invest into China in 2014 and 15. We're still holding it right now. But really, what we make us really proud and able to share with all you guys is we entered in the U.S. market in 2012, and again, single family residential. And but we did our first multifamily projects as the one that I shared with you, able to raise capital, able to do the renovations, able to work with investors, and really bring up the values to investors, providing really what we talk about is stable cash flow. And we haven't missed, again, this is really proud, we haven't missed a payment to investors since day one. And we have been able to provide stable cash flow, and we are about to exit the investors at this time. And that's why we're um, so um, excited to be able to doing what we're doing right now, because we know that the market is turning and the market is going to be very favorable for buyers, for investors, like to going in and really work with passive investors. I've been doing this Zoom call at the beginning. I told you about that. This is the 18th Zoom call for 2012, 2020. Um, um, my apologies, 24 meetings and presentations so far in 2020, over 3,000 audience online, been doing counting everywhere from Facebook, YouTube, and Zoom. So I'm really fortunate to be able to share what I truly believe, which is investing in apartments and investing in multifamilies and doing this in US and be able to find the lucrative opportunities that is under 30,000, as I said, and some of the even lower, but to be able to scale. Because when the good thing when you buy multifamily at such a low cost basis is you can actually scale, and you can actually scale and providing economical scale so that you can grow and provide acceptable returns for investors. That's really the key thing. Is we believe in the great asset that south of the border were, has been and will be continuously be able to help us to grow into this recessions and recovery. And but today's Zoom call, I'm going to go through a few things. It's what a few markets that has been doing well on rent, And when I look on the news, I was also surprised personally. That's actually some of the market is actually doing decent, and that's some of the market obviously doing very very bad. And I know, I think in New York City's only 60% were paying rents for June, and that's of course creating a lot of issues for big market like the primary market like this, like that. And what market is suffered by COVID, right? And what is asset class that has do well, and continue will do well in what we're gonna go into the next cycle and the recovery. First of all, we're gonna go through the adjustment cycle, and then we're gonna go to recovery. But really, what is the future hold, right? And my multifamily mission is really going to be, I've been sharing this week in and week out, month in, month out. You can invest in multifamily and produce on cash flow, right? You can invest in multifamily and produce a lucrative cash flow. I truly believe in that's really one of the few things that you can do right now. Not only talk about the office and the hotel and how those asset types has been hot heated, and not even talking about other asset type and apartments, and in that time like this is do has do well in the past. But what the recession hits when everything changing from consumer behavior all the ways from how we live our life. I have mask here because when I actually go to the common area, I have to put on the mask in the office. So that has continued to evolve, that continues to change. But what really we believe and what we seen in our stats, collections, and even we actually increase our property occupancy at time like this, which is we know that we will do well, but which is confirming that apartments will continue to do well because just the necessity basis of a lot of homeowners will be selling the home and moving into apartments buildings, and because of necessity, because of the economic challenges that they're going to face. So, but we believe in that cash flow is much better than single families, and you can own and create the economy of scale with apartments. And that's why I invest with my company Hated Break invest with other investors, which are really fortunate, and we continuously doing so. But also realize that as I started, some investors like mine, I remember years ago, I don't know where to start, and I want to educate myself, and that's hence I created. Actually, this is one of the great milestone for Hated Break and for our company is we create X-Step multifamily investing program that investor can go online and learn it how to do investing, just like the way that I have done, just like the way that many Canadian investors want to invest in multifamily. So a little bit of overview. This is a really funny because I look at a Yardic matrix. This is the 2 months ran. The top 10 market has been doing well, and I'm gonna stay in this live for a little bit. I'm not gonna go on individual market because that's so much to cover. But what I really find it interesting is, and on this report and other report is, um, the Midwest continues to do well, and you see all this is a secondary report, secondary market, and that is not your San Jose, that's not your New York, that's not your Boston, that every investor will flocking in, paying, arms and a leg to get in an apartment. We don't. Our philosophy is never about buying the top jewel real estate that we can never increase the value. Our value proposition of our mandate is find, unleash, and really find the gems market in the secondary, sometimes in the tertiary market that can actually provide the return. And some of the market you've seen this year, Ohio, it's continues to do well. We focusing on Ohio as some of the investors know. we are very fortunate. Our market is on the top of the top 10, and that has proven that we. I think that's proven that the marketing strategy that we were going in, believing in market that actually have diversified economy, and also that not paying over 100,000 per doors, makes sense. We when we talk about some of the Ohio market, we talk about 20,000, 30,000, or maybe 40,000, and we talk about well about seven and a half cap in terms of apartments. So that's how we can weather, you can so to speak, weather the storm where we're going in, um, um, because it's much more affordable for renters, and the economy is much more diverse. And so take note of those market, some of those market you may not even think about, but I'm really positive that we continuously invest in secondary market for hate to break, and I think that's one. This is what someone say in the U.S. say, investing in secondary market is good during the good market. Investing in secondary market is great. Is great. Is awesome during the recession time. I think this also showcase that, and I think you should not be surprised some of the high level you see on this market. This is the bottom 10 market that rent has been trending down. We only talk about 2 months going into the recessions, and we talk about some of the really big market, San Jose, Los Angeles, and there's no surprise really. It comes down to, you know, the Austin, Jacksonville, Los Angeles, Boston, San Jose. All this market has been really aggressive in terms of rent. When you're paying 3,000, 4,000 for one bedrooms, that when you lose the jobs, and dependent lose the job, is really hard for that demographics to be able to really continue to pay the rent. So the rent has been decreasing, and what that does, of course, will create the downward pressure for commercial real estate, which is have a direct and unfavorable um, consequence to investors. So we're really proud that we don't invest in the top primary market like that, unless it has a very good deal, and unless it has adjust to the way that we really going in. But we don't really see that. So we don't really see that. So on this market will have a fascinating effect for investors who invest in those market. And what that does is they're going to be moving the capital, because some of the investors find that they were in 2 cap 3 cap, and they can cash flow, and a time like this is going to make it even more challenging. And what we're seeing is some of the investors, this trend has been long lasting trend since 2015 16. Capital is moving from primary market to secondary market, and what we see is what we projected is those investors will be slowly moving away from the primary market and go to the secondary or suburban market, so to speak. That's maybe in the Midwest, on the center of the country, and they will also help us in what we're targeting in our market in Ohio, in Michigan. So those are secondary market that we believe that has a really strong, really great opportunity, and what we're going to see in the future. So the implications, and from this report, I really like that, and that's why I showed it here. Is the rent cycle has end. The rent growth cycle has end. The multifamily has the longest ever run in the history, and asking rents go by 26% since 2015. And if you're looking at way more earlier, since 2012, the rent is even more higher. Since March, more than 40 millions of Americans, pardon me, have lost their jobs, and the employment rate has skyrocketed. And I know we are closely monitoring where the Congress will passing the next the next recession plan, with more money going to the market. That many people expected will. It better be will, because if not, the correction of the market will be even more sustained, will be even more pronounced. So layoff is more again on the lowerly lowly wages, unfortunately. But what it does is also creating a lot of tenants is combining, into, for example, one bedrooms or studio, now they're going to two bedrooms apartments. So that's a trend that has been evolving. So a lot of property owners is concerning about getting rents. And there's one thing that didn't show here. A lot of homeowners is actually going to be going back to the rentings because of the uncertainty of the market. Because of the market will probably last, if it depends on second wave or not, whatnot, but we don't know. But it's going to be creating a much more tenants from the homeowners, which is more favorable for what we're doing, of course, as property investors. So you also saw that on previous slides, of 18 metros, rent growth of 0.6% during the time, and none of them. This is really fascinating, and that's, I try to answer investors all the time. Investor always asks me, so why not Los Angeles? Not why not Orlando? Why not New York? And why not Boston's? It's really summarized in the next statement. None of the high growth that cities that we saw is among the top 20 largest metro by populations. And but the thing is, half of them, this is really key, is in the Midwest. And I think there's two things that just highlight our business model. And when you talk about hate to break our own company, is we intentionally, when we set out in 2015 to go out, find and reach the market, we intentionally um, move away from the cloud. You can say move away from the cloud, because we know it's already so packed that that's not going to be have enough space, and it's going to be have a lot of competitions that have been sharing over the years. And none of that top 20 will do well because of migrations, because of tenants want to move away from big cities. But half of the 18 high growth, which I believe it will continue to stabilize on the next recessions, on this coming recession, is Midwest, because again, you have huge infrastructure in the Midwest because it's connected to the whole country really well. The 60% on the cities that is connected in the Midwest areas in 2 days by drive. And but not least, lot of tenants is moving away from the metro areas because they find it's much more affordable during recession times. Again, this is not only a medical crisis, this is also a financial crisis. So the only one way for tenants to move in to more favorable cities to live in, which have less living costs and lower living cost standard in terms of housing, in terms of a lot of things, which is what showed on Columbus, Cleveland, Ohio, and other Midwest cities. That is very key. That's very key. And we know that it will do well because of this aspect, if not even go higher the rents. So that's actually very exciting. It's validate that we are picking the market correctly in the Midwest, and continuously to do well in time like this. So more family moving into two bedrooms or condensed living from studio or one bedroom. um, you know, another thing is, pocket asset class, when most investors, a lot of big funds, if we're investing in office, retail, hotel, now suffering, and that's the only one left is really comes down to industrial, medical, and apartments. And apartments is continuously needing people continuously needing a place to live, whether you own or you rent. When you cannot own, then you only the other way is to really to rent. And that has continued making us hit the break doing well, because that's really important for people who are staying at home. You have millions of people, 40 millions have fire unemployment in the last few months. and this is not even. So the next wave that is you're probably not seeing online is, um, the bankruptcy rate will go up, right? And talk about business and personal. So foreclosure will come up. The government has been printing money, but the thing is, they cannot continue printing money forever. And the major city have major outbreak in California, in Texas, in New York, and all these major market will have second wave and third wave, because of the huge concentration of people, and will put the pressures on, on majors apartments and on office retails. So that will create kind of like a domino effect for investment capital going to the market that we're focusing on. That's what we think. So um, but I believe we are positioned as a company in a really interesting way, that position in the right market, positioning in in the good asset class. We are so fortunate that we don't invest in the office or in the retail sectors. We only focusing on the apartment sectors, with our investor capital, that is continuously doing well. But some of the things that I'm not going to spend a lot of time. We do this boot camp, Zoom call, group calls, monthly meetup call, and we're trying to do one, depending on where the market is going to open up, on we recorded with the recent market, and in September we have someone registers. We have, and then we're going to go on that. We have been constantly pushing that, but we'll see when the markets are opening up. And then of course the home studies. So there we are. We have some, good markets, some bad markets. What are the asset class that we think that we continue doing well, and what's the future? Um, I, as I said, I want to keep this really short. I intentionally add these slides because it really highlighted, our hate to break investing process. Find the right market. Um, Ohio or some of the Midwest market is host to the majority of the population. Not only you have diversified economy, not only that you have more resilient economy because you don't have the COVID affecting not many cities. If you pay attention, not many cities in the Midwest is affecting. Chicago is probably the exception, but the thing is, Chicago is really huge, and Chicago is also very pricey, which is also not our market. But picking the right market is our model. The right deal by extending a team and building and finding very viable opportunities, which we're going to see more as we partner with our brokers, agents, our commercial real estate team in all those local market. But really comes down to to executions. What other we call it, how to place your capital. We really come down to our last success, giving us confidence that we know that you need to do. Really comes down to knowing your market and knowing your competitions. Come down to knowing to the immediate uh, neighborhood. What is your market rents? What is your own rent, and how much can you push the rent, and still providing a viable living conditions, safe conditions, for everyone, for the tenants in this pandemic. And then as our last refinance is, we're able to increase the property price, a preferred price, over 53%, and that's by, again, executions. And really comes down to also active partnering with we have investors. We keep our open communications, really transparent with our investor, what we do, how we close, how we find, and eventually exiting of the investment. So it's really comes down to knowing the right market, finding the right deal, finding the right partner, and investing with the right investors, and providing transparency to all our stakeholders. Um, Come down to that. And next next meeting, I'm just going to close, and open for questions if you guys have questions. But next meeting we have on August the 8th, we have a pretty typical meetups on basically teaching investor how to creating your team in investors. and how to create your team in, and finding your mentors. If you are new investors, finding your, maybe on a meeting you can find someone to mentor you, and really sponsor, like, how do you sponsor deals. Sponsoring mean that able to get the deals, get the loan from the lenders. um, um, so and I'm going to open up to Q&A and see two questions here. One questions from me: what's the range of population in the cities on your list? Um, so, well, the biggest thing is right now you really want to focusing on, at least on our strategies, is you really don't want to focus on market that is too small, because it's come down to knowing. So remember that what I mentioned, those cities do well, but that we don't actually learn about how to investing, or we don't do the market research right now. We Once we fix the market, we know those market will do well, and we continue to pour in the deal flow. And one thing I can say to you is, um, it it is, the market will not change from day to day. If you know a market do well, it will continue to do well, and because of the critical mass of the cities. But I'm going to say that if a city that has less than half a million people, then you really have to have find a really good deals, because the city or the market need to have sustainable population in order to sustain multifamily. But on the flip side is, if you go into smaller market, um, you're going to find property that have higher cap. But we continuously to do well in the market that we're focusing on. We continuously to get deal flow because of the existing relationships with our investing partners on our market in Ohio, on Michigan, and but that I think I'm going to stop at that. But I want to say thank you for leave it to the floor for more questions. If not, then I'm going to say that thank you very much for joining us today on the Zoom call. But for questions, for learning how to do investing, or you want to partner with us to be a passive investor to produce passive cash flow, uh, feel free to reach out to me at howwouldahatetobrake.com, and feel free to check out our portfolio and what we have been doing for investors, and our investor call. I want to say thank you for joining us today, um, and and thank you, Will, and yeah. So thanks to everyone on Facebook and YouTube, and hope you well and continuously to do well and safe, and bring a mask to where you go. Thank you very much, and hope you have a good day.